Welcome to Investing with IBD podcast, sponsored this week by Growth Stock Mentor. It's Justin Nielsen, your host, and it is Wednesday, November 17th, 2021. And of course, along with me for the ride is Arusha Paris, O'Neill Global Advisors Portfolio Manager. Welcome back to the show, Arusha.
Hey, it's great to be here, Justin. As always.
Absolutely. Good to have you. And we've got an old friend coming back to the show, Ross Haber. Ross is the co-founder and head of TraderLion. Back in the day, he was a portfolio manager for William O'Neill and Company. I guess Ross and I were hanging out, 20 plus some years ago. He would come down with Mike Webster and Charles Harris, and we would chat about stocks all the time. So it was a lot of fun. He also was involved with a hedge fund, Infinity Capital, and hey, he's got a lot of knowledge, and luckily for us, he's going to be sharing that with us today. So welcome to the show, Ross.
Thank you, Justin. Good to see you guys.
Absolutely. So on today's show, we're going to be talking about markets, and specifically in this market, Ross was telling us how he's been doing some proactive selling. So he's going to share some of those examples with us, but let's get right to it. The NASDAQ composite, maybe we start there. Looks like the 16,000 level is acting as a little bit of resistance. We popped our head above there earlier in November, and looks like we were, after this little pullback that we had, looks like we're trying to get back up there and taking a little pause. What do you think, Ross?
Well, absolutely. So we had that sharp little pullback, which lasted, all of 2 days. No, actually last week, right? We hung out under the 10-day for maybe 2 days. We've rallied back. I mean,
can't call it a correction,
right? As far as volume,
it did feel like a correction though for that one day.
Well, there was a correction in stocks. It looked like
at least for one day. Yeah.
Mm-hmm.
Yeah, there were definitely some stocks that, if you were heavy in, you definitely felt some pain that day, and that are still working on fixing themselves. And not that there's anything wrong, in this market, especially, right? That's what led me to, the whole proactive selling that you had mentioned, Justin, is just the volatility in this market and the whipsaw, that sort of thing. So yeah, so let's, just Tesla, big leading stock and a big leading group. The pullback, or whatever you want to call that, that was a painful pullback if you had a big position in Tesla. Is there anything wrong with it? Probably not. However, doing a little proactive selling there, even a third of a, which we'll get into, would have, taken some of that nauseous feeling out of the way, right. Last week as the market came in, and maybe it gives you a different perspective. Maybe now instead you're looking to, hey, that worked, I can buy. Now I'm looking for a good risk reward spot to add that stock back, right?
So how aggressive are you positioning yourself right now? I mean, again, this has been a market so strong, it didn't even come down to the 21-day moving average line, snapped right back. There's certainly, it seems like this buy on the dip mentality that has been in place for a long time, but there's also this sense of, man, we've come up, for so long. How aggressive are you getting?
I've reduced my overall, as far as aggressive goes. I used to be, as I've discussed with you, a big fan of always being on margin. I'd tell you the new, being fully invested now, anywhere from 85 to 100%, depending on how concentrated your positions may be, and what those, some of these stocks have some crazy ranges. If I'm not, we're looking on average, some of these super powerful stocks can move 8-10% in a day without a problem. So you don't have to be 200% long when a couple of these things get moving on a volatile day. So honestly, I use very little, if any, margin now. I find that, being anywhere, like I just said, 85 to 100% long feels like it used to feel when I was 200% long before it got so volatile. Now, mind you, I haven't done a study. These are just observations. So maybe 10 years ago, I think, when I was running the fund, that was 2004 to 2010. It was a lot more money than I'm running now. Our prime brokers margin department learned to hate me. They were on the phone with me at the end of the day, every day, yelling at me to sell something. And now you just don't need the margin. Whereas I could stand, when I say stand, that it was still, nauseating to watch a big drawdown concentrated 200% long or whatever, 190% long. I'm starting to feel that nauseous feeling at about 90 to 100% now. So, whatever, if that, so that to me, it's gotten twice as volatile just based on that. And to be quite honest with you, I was doing a lot of this. I'm very good at getting in and piling up a whole lot of money. And then, you get these big drawdowns were just killing my equity curve. So I was making progress, but the trip on the way there was just, it was disturbing my sleep and my aftermarket, whatever I was doing. So eventually I go back and I make rules, and now I've got rules, and we'll discuss later. I've been forcing myself to stay lighter and proactively sell some stocks as they're getting extended off a 10-day, no matter how much I believe in them and how big I want that position to be. And I'll tell you, my equity curve has improved so much. It's incredible. I don't want to put a number on it, but it's a huge, you can feel it in my stomach and my heart, how much better the equity curve is. And believe it or not, now my account is hanging out at constant highs instead of having that,
right.
Those big swoons have been taken out. I'm still making plenty of money fast, right? So I want to see that I've changed what I was doing, and then I'll readjust from there depending on, my feedback at the end of the month, basically, is what I'll do.
Ross, how much does the overall market analysis figure into your strategy? Are you looking at the NASDAQ and S&P and paying attention to distribution days and how far extended they might be above the 50-day moving average and things like that?
Yes and no. So so we can see as we came back from summer into fall, or whatever you want to call it, we've got this massive volume. Oh, we're not even sharing screens, are we? So I'm looking at a NASDAQ daily. Should I do a share? Oh,
no, yeah.
Okay,
yeah,
so
we can set it up.
Okay, so perfect. So we've seen you've got the volume came way back in. There we go. Come way back in. Even after that pullback, you can see look at the volume on the ups, the blue days versus your pink days. Yeah. So it's not surprising that we're hitting resistance right there at 16,000. But ultimately, as far as distribution days go, and I absolutely watch the count because it at least gives you an idea of what's going on with big money. I would say this though, watching distribution days used to almost be magical. If you saw 3 or 4 distribution days show up in 5 to 7 days, I questioned nothing. I was so close I was down to 20% positions or cash in a hurry. And you could bet, even if it took a day or two before it finally wobbled and cracked, you just felt like the king. It was magical.
True.
And it just, it doesn't have that, whatever the reason is, has it been factored out by, the high frequency algorithmic guys? I don't know. So you might make that argument, and maybe one day it'll start to work that well again. But I always talk about it. It's worth keeping track of, although I don't make any buy or sell decisions based off of it.
Okay.
I would say this, the one thing that always, really stuck in my mind, whether, whoever I talk to, this from Bill to any of you, watch the leaders, right? Watch the lead, the market being the greatest discounting mechanism on the planet, right? They say it takes into account everything known and unknown going out 6 to 9 months. So the best indication of the market, if not the market itself, is those leaders, right? So I have been creating lists, setting alerts, and screening the market. Started with Wanda. MarketSmith now allows you to do it in the same way, such that you don't really need Wanda if you don't need all of that screening capability, whatever. That's neither here nor there. But I have developed a way whereby where I'm setting alerts and keeping track of groups. And I guess I keep a constant picture of that rotation of leadership and where the market is in my mind. So even though we do, how many stages have we gone in which groups that are leading? But also stuff like this. And there's, I have finally put a couple oil stocks on the top 10 report, which is almost never happens. I put on CPE and MTDR because at the end of the day, the trucking stocks, it's a small group. I'm not going to buy them. It's just not what I'm going to do. But so when I do see these, the more classical O'Neill type stocks, the technology, internet software, that specialty retail, if you will, when it's working. And you're starting to see that too from Children's Place, PLCE to, so as long as I'm seeing rotation, right? So I'm seeing Apple start to break out. We saw Shop break out last week, maybe a week before, where to me, FB is setting up. We're seeing money come into retail. We're seeing the financial stocks do well. So as long as I'm seeing all of that going around, and money, not my money, but the market's money can go into these other areas, that to me, that's what ultimately holds up that market when you see it stuck extended, right? So
Ross, have you been rotating from, because you mentioned a number of these, and this really has been the year of the rotation, right? It's
Industrials,
been going from oil
materials, steel, all these.
I watch it for overall health, like to gauge the overall health. So when we're pulling back, as long as I feel there's high quality names in these other groups that are set up for the guys that want to buy them, and it's not an all out, holy cow, there's really nothing setting up anywhere with any growth, and people are selling and going to cash. They're not putting the money anywhere, right? So that's what ultimately then the market folds.
Right.
So I'm always looking at it that way. I'm always trying to judge the health of the market by how broad rotation is. So even though there are not a lot of, you're not going to see a lot of these groups necessarily on the top 10 report, I'm constantly still watching the financials. A lot of these oil stocks, I talked about them today. The financials are, we had a downtick today, but the fact that these have all been playing along, and now we're starting to see rotation into some of these big, larger cap tech names that haven't been participating. As long as there's something to catch that money, I'm happy. So, even if as long as I see what I consider healthy leadership, healthy, broad leadership. And I guess it's how do you define that? Well, I guess there's a checklist. I don't have one. I guess it's just been built in my mind. Like I always say, I do my trading on TradeStation. That software was AT Financial, which I've been using literally since 97. Wow. So I have set up my intraday charts on TradeStation and my Wanda or MarketSmith the same exact way. And so I have built the same process, and I have never changed it to keep a picture of the market in my brain. So it's a constant movie, I guess, that I never stop screening the market in the morning, on the weekends, during the market, after the market. It's just constant game for me, right? Trying to find, it's like constant treasure hunt, I guess you will. But I've also realized at the end of the day, it's like counting cards, right? The deck is hot or it's not hot. Yeah. And understanding when it's hot and when it's healthy, and when to really, when the market is cooperative and cleans up your mistakes,
forgiving,
versus when it's not. And really, it's just a matter of if I would tell you, if there's any one thing to figure out, is maybe not only try and make a model book of the biggest winners, but get an idea of what leadership looks like when the market is healthy and in an uptrend. How broad does it get? What's it, versus when the market, in 2008, when the market topped and finally rolled over, I mean, leadership was screaming at you that there was something wrong. When I tell you there was nothing to buy,
that's true.
There was nothing to buy. I mean, you got pushed to cash and there was nothing to buy. And so it wasn't surprising, and it's funny, we get into the whole thing. Some of the really brilliant fundamental guys, I don't see anything, this is like this. It was like short central. I don't do it. We sat in cash, but it's so funny that that whole we buy on fundamentals and technicals, but we sell only on technicals, how well that holds. Because, the fundamental crew thought the economy, there's nothing wrong. Everything looked perfect as the market just got pummeled. Right. Yeah. So.
Well, one of the things that you were talking about that really kind of helps you in this regard for keeping those profits is this proactive selling. So when we come back from the break, we'll go ahead and take a look at some of the proactive selling that you've done and why you make this such a part of your routine. Stay tuned. We'll be right back. Bill O'Neill, founder of IBD and a legend in the world of growth stock investing, mentored Jim Ropel, and it changed Jim's life. Now, Jim is here to mentor you. Take your free trial on growthstockmentor.com. Every week, you'll get Jim's thoughts on the market, his ride the wave plan, Jim's favorite true market leaders, 2 updates each week, and a live members-only meeting once a month. Also, you can ask Jim anything, anytime, 24/7. Take your free trial on growthstockmentor.com now. Welcome back to Investing with IBD podcast, sponsored this week by Growth Stock Mentor. It's Justin Nielsen, your host, along with Arusha Paris, and our guest, Ross Haber, co-founder and head of TraderLion. So Ross, one of the big things about this market is, man, you've got some stocks that are going up so fast, so much and so fast. But they can also come down very quickly. So let's talk a little bit about proactive selling. At what point do you say, man, this is unusual. This is crazy. I'm making so much money and I just have to take some off the table. So what's kind of your rule of thumb?
So, as we discussed earlier, I have been really good at getting into a stock even early, piling it in, letting it, break out and get, stick up in the air for me. I would say this, let's just call it 10 years ago. And prior, when it was much easier for me to sit on 200% margin. As I think about it, I think a lot of the reason for that is why, even on a volatile day, I guess the alpha in the portfolio, or I think maybe it was just the way the market was at that time. It would seem like, let's say I was getting beat up on a couple over here, I'd usually have one or two saving me so I could sit there. I think a lot less. So that hasn't worked out for me as well either. So overall, so now, for starters, let's take Roblox, for example, today. I know everyone's had their eyes on it.
Yeah.
So that's one I bought in decent size, a little bit on the early side. To me, depending on how you play it, you could.
So roughly, where were you getting in on this one?
Well, into earnings,
Okay.
Prior to earnings, that first push up day.
Over here?
No. Where are we? Here, no. So wait, is that prior to the earnings day? I think just that.
So the earnings
so
was,
off of the average, I was in and out of it prior to earnings, probably for losses, right? Versus this average as we all had. You get closer, but so my average is 101 and change. Let's call it 60, 70 cents. I'd have to look to see exactly. So to me, versus 103.87, given earnings are in the way, for me, that's as early as you're going to safely be, unless you bought it and you just rolled the dice through earnings and sat through all of that. So once you're in here, you can see Market Smith makes it really easy. We're up in that green area. That means from the breakout to that point where that green starts at 20% and stretches to 25%, right? Yep. So we know that. So we've got an early stage 1B base, however you want to call it, base on little base. We've broken out. We're at that range. I force myself, as uncomfortable as it feels for me, because that's a big leader. I feel like that's one, if Bill was looking over my shoulder, he'd be like, are you sure you want to be selling any of that? Instead of just waiting for it to set up again and, maybe adding another 10%, which maybe he could do and sit in a meeting and not, throw up on his shirt while it's whipping around. But
Ross, let me stop there for one second, because I have Roblox too. And it's funny to hear you say that, because I think I'm going through the same kind of process. Before, I would hold these are the kind of the perfect thing. This is the perfect kind of reaction.
The volume.
Yeah,
you don't want to
this
give
is
up
what
a
you don't want to
single
sell.
share.
But it seems like the market, maybe it's this year's market or over the last few years, where they don't hold up as well. They will come back and test a lot more than maybe in years past.
Absolutely. So I would rather now, watch it gap and go another $40 tomorrow with 2/3 of my position. And then, from there, I'm going to be maybe a little bit more careful. I always remember, just the thing that Bill said that stuck in my head is, once you sell half, there's just something about once you're down to half that pushes you to sell the rest. So I'm always trying to keep it to quarter to a third. But for now, I went back. My big issue was I was piling up profits and then getting too jazzed by the chart, by the story, by the earnings. And, I want to be William O'Neill and have all my money in one stock. And, that one person can do that. And his name is William O'Neill. And so is uncomfortable and against my nature as it feels now. So now, it's not hard to see, Roblox broke out and ran 20% in roughly 3 days. It's very extended off all of its averages, but so it's tough to see. I mean, you
Right.
can, I can't really go to the left and say, well, hey, it got this far extended off its 10-day moving average 2 and 3 times to the left, and it's about here now, which is a game which I wouldn't even say it a game, but is something I'll do even on an arithmetic chart, keeping in mind that it's arithmetic. And, you know, I learned that honestly from sitting in a meeting with Bill, you know, as unscientific as it sounds, you know, just so keeping all of those things in mind, I'm trying to keep it to, you know, a third. I don't want to go quite to a half, and I'm forcing myself to sell these things. And, you know, at the end of a month or two, when I go back through, I'm trying to make a change significant enough that, you know, I've either gone too far, but I want to see it change what's going on in my account.
Well,
so if it goes
Justin,
down,
Ross, would you use this kind of action over to the left-hand side when it emerged past like the 80 level up to 8?
Right.
Because that roughly was like 25%, right? And they're emerging out of that consolidation. Maybe it's still within character, and hopefully it doesn't come in as hard as it came in last time, but maybe that is kind of the character for the stock. We'll have to wait and see.
Right.
Goes up 25, 30% and then pulls back.
You know, in mind, it could go to 150 first, but yeah, just yes. And yeah, absolutely. I'll watch that, and I'll constantly be watching. Let's see how it starts to catch up to its 10-day moving average and, you know, what the market's doing and all that sort of thing. But yeah, that's very hard for me to do. It's got that massive volume, you know, all of that going to, we all know the story behind this one. You know, you want to, I don't have kids, but I know that no Roblox is a big punishment for those that do. So,
so now if this pulls back, you know, so how do you handle the 2/3 of your position? Are you waiting for a pullback to maybe buy that third back at a lower price, or how much is too much for this to come back in?
Ideally, I would love to see it, you know, what is too much? I don't, you know, a reversal of that entire breakout would be a problem for me. That would be unusual, right? To see it come all the way back in. Right. So I guess I want to see how it builds up here. Maybe it consolidates while the 10-day catches up. Maybe I have no idea whether it'll start to tighten up or continue to, we'll see how those are, you know, so now I'm just watching, and I always try to remember little, you know, one of those little things, the lowest price isn't always the best price. So even if I have to buy it back higher, where I can manage risk with a whole lot more confidence, what I'll often do is buy back double. And if it's a liquid good one, triple what I sold with super tight stops. Can't be wrong. And as that's working, I will sell the extra and try to, you know, reduce my average and make up for, you know, I'm going to tell you though, most of the time I'm not having to chase these things higher. And if you do, you do, and you still have 2/3 of your position left. But I'm going to tell you 8, 9 times out of 10, the volatility of the market, even if the stock's going to be fine, a concentrate, you know, something like that can, you know, you get a gap. That with a weak market, everything, it can do something to your brain and force you out of stock that you shouldn't be. So I'm trying to avoid that. I'm trying, you know, a lot of that was happening, right? The emotions come, and even though there may be nothing wrong with my stocks, I got too heavy too fast, and I'm just not willing to give away any more profits, right? I have so there's that also, that I have, you know, a cushion at some point that I'm just flat out refuse to give up, no matter what stocks I own or where I am. And so I was getting pushed to that point a little too often with the wild swings in my equity curve. And so I just needed to fix. So this is just, so what I've done, without going on and on, is I've reduced margin considerably. I used to be a full boat of margin and then some, and now I'm hardly ever on margin. I try to keep it between. Fully invested for me would be more like 85 to 120% if I'm getting crazy, and I'm always trying to keep it on the lower side, you know, peeling off partial positions of stocks, especially as they get extended, like a Roblox, as and waiting to see what happens. And long story short, that has kept my the equity curve has smoothed out a whole lot, and my account is, you know, obviously as a result, my account is sitting much closer to highs on a constant basis now, instead of like, okay, I'm still up, but man, I just gave away a ton of progress. Okay, yeah, it was the house's money, but it was too much of the house's money,
right? Yeah.
Right?
It still hurts.
Yes. So
do you find in this
anyway.
market that because, I mean, there's so many IPOs that have come to market, there's so many of these like new technologies. I mean, in some ways, it does feel a little bit like the late 90s where you had this massive thing, the internet, but now you've got all these kind of sci-fi things that we're talking about. You've got AI, you've got electronic vehicles, you've got, all of these things, a lot of IPOs. Is some of this because you don't have the trading history behind it that you're making these decisions of like, okay, let me just sell into strength, or is it just really that you're finding this in some of the even more established stocks too?
Yeah, that's exactly it. I would try and hold those, let's say 40 to 60% positions in a established big leader liquid. It's got all of but the volatility, it doesn't really matter what that was my problem. I think I'd fall in love too much with the Tesla or a Roblox. And at the end of the day, if you've got 40+% and you've watched a big run, one of these things coming in, and if two of them do it in a day, and it turns your brain and your stomach upside down, or at least for me, it got to a point where it was turning me upside down to a point that I couldn't handle it anymore. So I cut it in half, right? As I said, we're going to try and not be on margin at all, which has so far worked. And just by a feel, I'll tell you, we discussed it in the first segment, that 85 to 110, 120% margin feels like full boat did 10 years ago, right? So,
Ross, so
that's me. Maybe, some can handle it, some can, but that's just my personal, this is where I'm finding my comfortability zone now. I can, a 20 or 30% position is plenty. 40 to 60 is completely unnecessary and unmanageable for me now. So.
Yeah, no, I feel like I've come to the same conclusion as you. Now, talk a little bit about the pulse analysis and figuring out how to adjust to this and how to change kind of the strategy, and forcing yourself to do something uncomfortable. I mean, that's a really interesting thing. And
yeah, you keep on using that term.
Yeah,
it's uncomfortable
right.
to sell
it
this.
Is. It's
so
very,
much. Right.
I always think about when I was sitting, and when exactly it changed to when I had to force myself to sell a Roblox, which normally was 40 to 60%. This time was only 30%, and now it's down to 20. I almost feel naked. I'm like, that's just barter now, and it's really not. But that's that was the mentality I had. And let me tell you something, it's great while you're making money, but it takes for a few weeks. But as we all know, like 1.5 bad days will wipe out the best 3 weeks you had. And if they used to really upset me for a long time. Now that I'm older, I'm very good at remembering what the good Dr. Ketcher taught me a while back, which is the opportunity of a lifetime comes every other day in the stock market. So when you're seeing the big, healthy, broad market, you got to do your best, excuse my French ahead of time, to keep your head out of your and remember that, dude, that's all. It's what you just did. It's all that Mark Douglas thing. It has nothing to do with the next stock and the next stock and the next stock. So turn it off, go for a walk, go sit on the beach, do whatever you have to do to, keep your head straight, and don't go back to trading anxious with that pit in your stomach. You're going to lose more money.
Yeah,
so
I remember one of the things that you used to talk about, Ross, again, this was 20 years ago, so I don't even know if you remember this, but I remember when you started speaking in front of people, one of the things that you told them that you would do is sometimes you would get up, get behind your chair, and say, okay, if I were instructing someone, what would I tell them? To kind of get out of your own head, get away from the subjective nature of it, try and make it more objective.
Absolutely. So, you'll find a lot of people, though, believe it or not, that, I've watched, without naming names, that are very good at, they understand canceling thoroughly, and they could advise you till the cows come home and well, but the second they put their money on the line,
that's true.
They fall apart. Story. And it's just, it's not bad or good. It just is, right? Some people have better control. I don't think I've learned to have better control of my emotions. I wouldn't say I was born with, is that emotional intelligence they call it these days. My emotional, my EQ versus my IQ, whatever it is. So that's anyway, super important. I've also, so a lot of this, the proactive selling, the staying, I'm saving it's my financial capital, but more than anything, what I'm trying to do is get keep my mental capital stable. So keeping the equity curve So I backed away a whole, and so far I thought backing away as much as I did and doing what I was doing was, but so far so good. It's made a solid difference. And now as time goes on, I'll go back and try and figure out if I could have been, more efficient, sold less, what could I have done, and, tweak the rules a little more. And, if I ever get to that. So I always try to keep it, my big thing is you'd rather be out wishing you were in than in wishing you were out. But
Right.
that all depends, yes and no. I mean, unless you've just made a big mistake, it's the beginning of a big run and you're like, oh my goodness, everything just got away from me. That can be a little bit uncomfortable, but there's always, the next setups to get back in. But yes, it's that FOMO. You see everything going crazy, tons of people, and it's very hard to tune that out, focus on yourself. It's very easy to have a bad day or a bad week while everyone else seems to be, making money hand over fist. And so that has been, keeping my mind and equity curve even keeled, a little more even keeled has been very helpful.
And it also sounds like you're going to be using your post analysis to tell you when to shift again. Like, okay,
absolutely.
Yeah,
absolutely. So I mean, immediately in your P&L when you're running into trouble, or like when you've been doing well, for whatever, maybe the market was real cooperative in cleaning up your mistakes, but immediately when things stop working. And I always go back and try and figure out what it is and adjust. So watch the leaders, and that constant post analysis and figuring out what you need to change are, those are two big things. And even just like we were talking earlier, timing the market, what's the market going to do? I don't know, get a great grip on what healthy rotation looks like, the health and breadth of leadership when the market's in good shape, especially when you have all those conflict, right? You'll see the McClellan oscillator, which I'm going to tell you is much better at marking bottoms than tops. That thing can stay overbought for a while. And so my little trick, and maybe, is this is just what I like to see. There's no study done. I watch the McClellan oscillator, put call ratio, and the VIX. If all three are at extremes and things are extended, I will go, okay, I will take that. But any one of those things in and of themselves, a high put call, a high McClellan, that can stay overbought or mean nothing for a very long time. And what ultimately makes the difference, if leadership is healthy, rotation is strong, and we're selling some extended Roblox, but we're buying Apple and some Facebook and whatever, it doesn't matter as long as those healthy, new setups continue to build. And that's what holds the market up ultimately, right? It's when everyone decides that it's that time, like prior to 2008, where you're forced out of your stocks and there's just nothing to buy. Right. And I promise you, the market's getting ready to, it lets you know there was plenty of time to get out of the way there.
Yeah. So when we come back, we're going to look at a few of the stocks that are on Ross's radar right now. So stay tuned. Bill O'Neill, founder of IBD and a legend in the world of growth stock investing, mentored Jim Ropel, and it changed Jim's life. Now, Jim is here to mentor you. Take your free trial on growthstockmentor.com. Every week, you'll get Jim's thoughts on the market, his ride the wave plan, Jim's favorite true market leaders, 2 updates each week, and a live members-only meeting once a month. Also, you can ask Jim anything, anytime, 24/7. Take your free trial on growthstockmentor.com now. Welcome back to Investing with IBD, sponsored by Growth Stock Mentor. It's Justin Nielsen here, your host, and Arusha Pires, O'Neill Global Advisors portfolio manager, that joins me every week, and our special guest, a former William O'Neill and company portfolio manager, Ross Haber, currently the co-founder and head of TraderLion. So Ross, let's talk a little bit about some of the stocks that you've been looking at. Maybe we start with kind of the cryptocurrency craze. I just read that Staples Center is changing its name. It's getting a name change to the crypto.com arena. Right. So a lot of this cryptocurrency is just coming up all over the place. Let's talk a little bit about Coinbase and how you've been handling this one.
All right, so another one that a lot of people have, a lot of eyes on this one lately, like you said, with the crypto chatter. I don't know how many there's a handful of names. I'm going to, as far as this is one of your higher quality names as far as fundamentals go. You can, looking right along the bottom, you can see the quarterly earnings, sales, pre-tax margins, that sort of thing. You've got sponsorship hasn't increased necessarily the quarter, the last, June to September. However, we got an IPO with extremely high sponsorship there, and you've got Fidelity Contra Fund. So, one of our, anyway, the fundamentals are there. You can see on that weekly, where what is that, 7 or 8 weeks up in a row.
Right.
And going back to the daily, we can see that it's starting to, earnings are out of the way, and it's starting to tighten up around its 10-day moving average here. So far, there's not a whole lot to look at to the left. It's basically, since the IPO, it's been in a downtrend or base building, right? We're technically we're still early in the stock. If we were looking at it in terms of your classical textbook IPO base or your IPO U-turn, you're looking at the high of the base, which I don't know, is right there. I don't know what the price is there, but well above
429.
Yeah.
Right. So, super early, and it looks like earnings probably got in the way, is that 294 mark. If you wanted to start buying early, maybe I won't get into, there's plenty of early spots that I've started that I personally buy up the right side of a base now. So regardless, let's say you were coming into this stock, you didn't own any. We can see earnings were reported right here. I don't know if you can see my cursor. Yep. So since earnings have been reported, you can see we got some volatility, crazy volatility in the stock, but ultimately we haven't so much as touched its 21. We've seen a respect for its 10-day moving average up until that shake in earnings, and now we're starting to reclaim and tighten up. We've got volume tapering off and well below average. So I have been trying to, on the pullbacks, I'm trying to add, as a max stop, I'm trying to play it off the 21-day moving average. I'm buying slowly here, right? Because here's how I approach this stock. I look at it, that stock could still touch it could undercut its 21-day moving average tomorrow, still hold the low of that shakeout.
Right.
And there is absolutely nothing wrong with that stock. But if you start accumulating it early in anticipation of a move here and you're wrong and it pulls back there, it's going to be a bad day for you, or it's going to be, at least it's going to be a tough one waiting for that to close. So I'm always keeping that in mind. So right now, and so for me, forget that coin is the best, the best, and stock picking, I think at the end of the day, if we were all to compare our lists with, with the guys that follow this methodology, 80 to 90% of our list is going to overlap, right?
Yeah.
So now it's going to come to how you handle them, when, how much you have, that sort of thing. So
you've got the early average cost, the lower average cost on this. So for someone just starting out, is this better to kind of wait for it to get down to that 21-day moving average line?
Justin,
So
I don't even
low risk.
I don't even know that I have, I started it, but my average now, because I've averaged up right now. So honestly, for someone based on how it is, I think you could use its 10-day moving average as a start. So it's very tough. How much coin do you ultimately want to have, and how would you build that position? I guess so. Let's say if you just had to have your mental health position on the books, whether it be 1 share, 100 shares, 1,000 shares, whatever is small relative to whatever it is that you're doing. So how many can you hold and have that happen? Watch it shake out to its 21-day and go, hey, that's normal and fine. I'm going to try and add there. And then if it actually undercuts for, pick a new spot to sell the whole thing after you've added. That's not going to be easy to do if you have a 10 or a 15% position already. But let's say you've put on 5 to 7%, and you see that happen. For me, it's always a lot easier to see a gap down on the open, like we saw with, I think it was coin yesterday or the day before. I think it was yesterday, right? Not today, but yeah, yesterday you got the gap down open and it made it starts to turn up into that gap. And then it becomes very easy for me on a day like that. I will often buy that U-turn and then just use the low of the day as my stop. That's how I will play that.
Yeah, you can actually pull up the 30-minute chart. If you just go to the intraday, you can see that gap down yesterday. And exactly as you said, if you just kind of set that low right there.
Right. So I'll even wait for the U-turn into the gap, and then low of the day becomes your, and then as it's going, you can build from there. So that's how I'll kind of, force myself into a stock there. When I was doing that, I have the 21-day moving average in mind, right? So I'm buying that and I'm going, how much could I ultimately hold, and watch that maybe undercut but still act okay and at least not sell, if not preferably add some. And now, mind you, we're breaking a rule there, right? Because I'm averaging down, but I'm averaging down knowing in my head, I've done my math. I know how many shares at max I'm going to hold. I know how much of a loss that translates into. I know exactly where that is on my chart. So I know where it is, why, how much, and I'm always playing within there. Let's say I didn't own any and I started doing it today. The reason I'm averaging up now is you can see, I mean, it had every reason to fall apart over the last few days and it hasn't. And we're starting to really show a respect for that 10-day moving average again. If you really wanted to play short-term games, maybe this little shelf below 350. But anyway, so let's say I had none, you could play it off its 10-day moving average here. You could buy it, right here, figure out how much of a loss is that you're anticipating again.
Take a look at Lucid LCID. This is another one that had that kind of big pop up and rounding out, coming up kind of this bottoming base. Not your typical where you're still well off your highs like you were with Coinbase, but it was really coming up this right hand side and really incredible move lately.
And I definitely screwed this one. I don't remember exactly. I'd have to look right now. My average on Lucid is $48.79. I originally started buying it prior to earnings here. I don't know what as we get closer and closer to earnings and things are moving around and the market gets volatile, I'm not sure what or why pushed me out, but I got pushed out. And so I bought it back actually just 2 days ago. I think I was actually chit-chatting with Ray and let him know. And so it had fallen into, but it came into the gap that day, right? I think it started higher, pulled all the way back. But as soon as it made the U-turn and broke back out, I want to say that number's 48.04 is high. The breakout, as soon as it went through 48.04, I blasted it at the market. And now I'm long 48.80 average, and I haven't bought any since. Problem with this one is I didn't buy a big enough of a position because I'm buying it. I'm feeling like it's a little bit extended, and I didn't put on as much as I should have. And so it actually, I looked at it today going, oh, should I take off a third? It's not really big, it's not really big enough. Do I want, so I wound up not selling any of it. If it was one that I had a full position of, let's say 20+%, I probably would have taken off at least a little bit of that one today as it became extended, just to follow that rule of, but it wasn't big enough. So I left it alone. It's currently my smallest position just by default.
And are you using the intraday charts a lot for your entries? Do you use them for your selling as well, or? So
the intraday charts I will keep up on my screen. I keep it very simple. I've got two 32-inch monitors. I've got 4x3 rows of intraday charts. Lucid, we were just talking about. So this 2 days ago, it opened higher. It fell back below. I'm calling this its pivot 48.04. But yeah, so I'm watching this on the intraday. It might be the 3-minute. It could be the 5-minute. I'm not sure, but as soon as that broke through, that it did its mini U-turn. That was it for me. I bought it. My stops are, pretty much. I'll watch it. I'll pick a bar maybe on that intraday chart. Maybe I'll use that 40, or I'll look to whatever I'm gonna. I'd have to. Where is my stops now? I don't want to babble on you, but I'm just constantly looking to see where my most logical tight stop will be based on my average, how many shares I have, how many I want to have.
Well, let's take a look at another newer issue, Airbnb, ABNB. Here again, we had a nice move on this one, reached highs of about 220, then has been basing, and now here we are getting back up to those old highs, a little bit more so than what we saw from Lucid or Coinbase. How have you been handling this one?
I had a position in this one that I had started. I'm not going to look at the end of the day. I wound up pushing it to almost to an irrelevant. It's an irrelevant position. It might as well beat
Once
a
you start the
cash.
selling, at a certain
Yeah, it
point,
was one of
just-
those things. It wasn't big enough already. And I would tell you this, had I not owned Airbnb, it's a very tough one. I'm not a big fan of the way that this, they'll call that megaphone expansion, not a giant fan of the way that has expanded. Also today we attempted that, textbook breakout, ultimately failed, big outside day down. That's all very easy to see. On the flip side, volume, yes, it did pick up on an outside day down, but if you look to the left here, now granted, we've become a lot more wide and loose than we were prior to earnings, but this is not uncharacteristic of Airbnb. If you go back and look, even, July, look in the middle of August, September, all of that action, ultimately, so when I look and see these big shakes are characteristic, it'll at least give me an excuse for this one to possibly do that. But at the end of the day, I'll be honest with you, my gut pushed me to almost nothing on this one. But it is interesting to me right there. It's holding its 10-day. We've seen it's not its first time it likes its 10 and 21-day, even while it was radically shaken around over there, correct? And now we're starting to respect its 10-day. It ultimately held today. So let's see what happens around that 10-day and $200 price mark that, Jesse Livermore par at 200. If we can start to tighten up and show some constructive action there, that will be, I will watch for that 10-day and possibly the 21 or 23 exponential, whichever you use, to catch up to price. And then we'll start to see how it acts right around that confluence of 200 and some moving averages will give me a spot to manage risk from, assuming it doesn't just fall below there tomorrow.
Mm-hmm. Well, this is a lot of stuff to think about. You got volume signatures, you've got that proactive selling, you got a lot of IPOs that we covered today. So Ross, thanks a lot for coming on the show. Really nice talking to you again.
Well, thanks for having me as always. I love talking shop with you guys. So anytime I hopefully help some people today, and I'll be happy.
Yeah. And on the show next week, we've got Dan Fitzpatrick. He's the founder of Stock Market Mentor. And so he's going to be joining us. But thank you all for joining us this week and listening to us. And we'll see you next time. Thanks for watching. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.